Good morning, good afternoon, good evening, good night. If we have some East Asian participants, wherever you are, welcome to the first presentation in the Best Paper competition by Idea Lab. My name is Horst Simon. I'm the director of Idea Lab in Abu Dhabi. And we have selected from among more than 30 participants, the 5 finalists for the Best Paper competition. The 5 finalists will make a presentation that is open, and I'm very pleased to see more than 50 people have signed up. So this is already a win for everybody involved. So even if the team of today may not be amongst the 3 winners, you will have already an international audience to listen to your research. So with that, I'm welcoming Jalal Etesami, Ali Habibnia, and Negar Kiyavash from Technische Universität München, Virginia Tech, and EPFL Lausanne, with a presentation about a time-varying causal inference framework for modeling systemic risk in high-dimensional financial networks. So we have the members of the Idea Lab evaluation committee, including some of our board members on the call, and I would like to invite our speakers to go ahead with their presentation.
Okay, thank you so much for the introduction. So good day, everybody, ladies and gentlemen. Thank you so much for having us here. My name is Jalal Etesami, and today I'm going to present this work, this time-varying causal inference framework for modeling systemic risk in high-dimensional financial networks. So this is a joint work with my collaborator, Ali Habibnia and Negar Kiyavash, as you mentioned, whom are present also today here in this talk. So let's go on and first see what is the systemic risk. So systemic risk refers usually to widespread disruption in an entire network rather than an isolated failure. So due to interconnection between the financial entities, it's very highly likely that the threat that a failure spread through the network and could potentially harm the entire stability of the economy. So we have seen such behavior, for example, during 2008 financial crisis. So due to this type of event, it's very important to understand the network of the interconnections between the financial entities and usually represent that using graph and understand and study this, which is the main topic of this presentation. So measuring systemic risk has been addressed in literature using 2 different approaches. For instance, the mathematical approach, which usually builds a mathematical model from a combination of the information from financial statements. For example, the market value, counterparty liabilities, for instance. This gives us a weighted directed graph and can be used to understand the systemic risk. Another approach, which is we also adopt in this work, is the statistical approach. And as the name suggests, is based on statistical analysis of financial series. But most of the traditional econometric models, they are usually correlation-based, or they rely on heavy assumptions, for example, linearity. They cannot handle the time-varying nature of the network, or they cannot address the high dimensionality of the problem. So in this study, we aim to address these the failure or these relaxed assumptions and overcome some of the shortcomings of the traditional models. So this also has been addressed in the literature. To review some of it, I'm going to go through a couple, just name a few of the works, recent literature that they try or aim to go beyond, for example, linear model, or understand the time varying causal relationship, or address the high dimensionality. But most of this work, if we look at them, they either handle or address a couple of these issues, or they are mostly parametric models. For instance, they address the nonlinearity by having a parametric nonlinear model, or they address the time variance analysis using, for example, some model based, such as Markov switching models, or address the high dimensionality, for example, using this in a var autoregressive linear models, using the lasso or other type of regularization. So instead, in this work, we aim to address all these issues or these shortcomings at once by introducing a non-parametric information theoretic base, and then namely directed information that can capture causal relationship in linear or nonlinear general dynamical system, and then refine it or enhance it that can capture time-varying relationships, and then also refine some estimations that can be used in high-dimensional settings or understanding the high-dimensional networks, and also introduce some aggregated directed information measures that can capture cross-sector influences. For example, how much influence the financial banks have on, for example, real estates and this type of questions. So these are some of the methodological contributions that I'm going to talk about today in this work. And we also have some empirical contributions, for which we have a research question that how much cryptocurrencies impose risk to the financial network. For that, we use our time-varying directed information measure for introducing and monitoring systemic risk of the network. Okay, so to begin with, it's important to understand what type of interconnections are important for systemic risk. So I start with this classical example in causal inference literature to show that correlation and causation are not the same. As we can see here, there is a clear correlation between chocolate consumption and the Nobel laureate per capita in different countries, but definitely this does not suggest that having more chocolate is going to give us a better chance to win a Nobel Prize. So the message here is that the interconnections which are important for systemic risk are not correlation, there are more causal relationships. So the causal relationship or causal network, typically they are shown by Bayesian networks in literature, which are directed acyclic graphs. In this, Bayesian networks node represent random variables, and there is these arrows in the network. They show the dependency or conditional dependence between variables. More precisely, the Bayesian network gives us a special factorization of the joint in which the direct causes are the parents, and there are conditions in the factorization. So these are very nice, concise type of graphical model for representing causal relationship in a set of random variable. They can also be used to represent causal relationship in time series, but the shortcoming for them is that the size of such networks grow with time in time series, and therefore they are not so suitable for representing time series as the size grow with time. So the researches in causality are usually of two flavors: the causal discovery and the inference. The causal discovery type of research is about learning the causal graph, learning the causal relationships from a set of observational or experimental data. So this is a long-standing problem in the causal inference. There are many works on that, but still very open research questions in that field. On the other hand, we have the inference type of problems or researches in which the causal graph is assumed typically to be given. We know the causal graph, and we want to use it to do a better inference For example, do a better prediction or answer some identification problems, experimental design, and so on, so forth. For example, all this identifying causal effect, these are the type of questions that are addressed in the inference research. So it's important to notice that what I'm going to present today is a research in the causal discovery. That means we are aiming to learn the causal relationship from observational data. Okay. So to go forward with and present the contribution, I think it's not bad to take a look of some of the backgrounds we have on causal relationship and causality in time series and what framework we are going to use here. So we're going to use the definition of causal relationship proposed by Cliff Granger at Nobel laureate, who, quote, says, "We say X is a cause, Y, if we are better able to predict Y using all available information than if the information apart from X had been used." So he proposed this framework for capturing cause and effect relationship, and then he formalized that using a linear autoregressive model. More precisely, for example, if you want to predict whether X is the cause of Y, you form two linear predictors. One of them predicts Y at time t using all the available information of both X and Y, while the other one does not use the information of X. And then compare these two predictors. If the performance of these two predictors, which are measured using the variance of the residual, are the same, that conveys this message that X does not really help to predict Y, and therefore Granger claims that X is not causing Y. So this formulation is limited to linear predictors. We can go beyond that by adopting the sequential predictor framework and having two arbitrary predictors, one using all available information, Y and X, and the other one does not use the information of X. And afterward, we can compare the performance of these two predictors using some loss function over a period of time, let's say capital T, and this gives us some value which we usually call it regret. So clearly, if the regret is 0, that means these two predictors, they perform the same, and therefore X did not really help predicting Y. And X we can say, or we are safe to say, X is not the cause. So more precisely, if we choose this loss to be log loss and the predictors to be belief or conditional probabilities, the average regret is going to be something known in information theory literature as directed information. So directed information is a quantity that is always non-negative. It's either 0 or positive. And when it is 0, that means X or the information of X did not help in understanding of Y. So this we can generalize it to a set or a network of time series. And this we can define a new graph representing causal relationship between time series, which we call it directed information graph. So now, directed information graph, the node represent time series. This is good because the size of the network does not grow with time. It's always the number of time series. And the edges represent the Granger causal relationship. For instance, or more precisely, as you see in this picture, if the directed information from J to I condition on all available information in the network is positive, then we say Xj is a cause of Xi. So this is really important. I should emphasize that we have to condition on all the information in the network. So if we miss some of the information in the network, or there are some hidden time series or unobserved time series, this directed information or this framework could lead to some wrong result. So this is the place, actually, the information theory started from Shannon, and Granger causality can combine and can have an intersection. So we can actually capture causal relationship using an information theoretic measure, which is this directed information. So it's good to, again, mention some of the highlights of this directed information. The most important thing is it's a model-free. It needs no model assumption. Works for linear, nonlinear general system. It can learn the entire causal network, given the assumption that there are no hidden variable and there is a perfect synchronization. So the sampling rate that we have for the cause and effect and all the time series in the network should be in the right order. So a nice property that I should emphasize here of this directed information is that it also gives a special type of factorization also of the joint distribution of the dynamic, similar to Bayesian network. This is the first graph on the top. It is called the generative model graph. This is defined similar to Bayesian network, but for dynamical system, for a set of time series. So the parents are the direct causes, and they are the one that they appear in the conditioning of the factorization. Below, we have the directed information that the edges are defined merely based on the directed information quantity. So these two graphs are identical if, for example, under some mild assumption. Mild assumption would be we need to have a positive probability, so all the events happen with non-zero probability, and we also need the strict causality, meaning that no contemporaneous or simultaneous relationship should be in the dynamic. Okay, so some words about the application of this directed information. This is something, this measure has been already used in literature in different areas, from criminology to neuroscience, financial and social networks, and so on, even for understanding the relationship between different earthquakes or the places or the times that they happen. So it has a widespread of application range. So with having said all these backgrounds, I think it's a time to talk about the contribution we have in this work. The first contribution is to modify or redefine the directed information that can actually capture causal effects between clusters of processes or subset of processes. Let me explain this better in this graph. You see on the left a graph, the black node represents time series, for instance. But imagine this, a subset of this time series indicated in red subset. There are all the banks in a financial networks. Or the gray one could be set of all real estate. The blue one could represent all the other financial institutions. So a subset based on their entities or their properties. So the question is, how much influence in this network is coming from the banks A to real estate B? What is the aggregated causal effect here? So just counting the number of edges between the cluster, this does not really measure this effect, but instead we first answer this question, that how much effect is coming from a subset to a specific time series. For instance, how much influence is from all banks on a specific real estate, for example, Boston Tower makers or so. So this, to quantify this influence, we redefine this measure that is based on comparing two beliefs. The belief on the denominator here, as you see, has the information of all the time series in set A, while the second belief in the denominator does not have this information. Therefore, if this quantity is 0, that means the information of A really did not help predicting the time series I, and therefore cannot be the Granger cause of it. So using this, we can quantify the causal effect from a subset to a specific time series. And as soon as we have that, we can aggregate it to define the influence from subset A on subset B. This is just the aggregation of all the influences from A to all individuals in B. So let's say we have this quantified. Now the important question is, how much of this influence is contributed by a specific time series in a set A? In other words, the question is, how much influence, how much of this aggregated influence is due to a specific bank, for example, Bank of America? To measure this, we adopt this one leave-out method. Namely, we compare two aggregated causal effects. One of them is from the whole set A to set B, while the other one is from the whole set A, excluding the time series that we are interested in its influence. Okay? So with quantifying this, this contribution measure, we can actually answer what is the most influential or least influential financial asset in the financial sector. So another contribution here is to capture the time varying causal relationship. So to do that, we need a measure that depends on time or can capture the influence at time t from one time series to another time series. To develop this, we adopt the rolling window method that has been used for example, in the correlation, understanding the correlation over time and so on. So the idea is simple, is that at a specific time t, if we want to understand how much or whether time series y2, for instance, has influence on time series y1, we select a window of length s around the time t, and then during this window, we have to ensure there is no leakage of information from the outside of the window to the inside. Therefore, we give the information from outside of the window, which is denoted by color blue, to both predictors. And then in one predictor, we include the information of y2, and the other predictors, we exclude this information, and then we compare it. Okay, and then we aggregate it over only the small window size S. This is going to be the information coming from Y2 to Y1 only within the rolling window of size capital S. And if we move this rolling window in time, then we can measure the influence at different times. So another important property that we have to encounter here, to have here, is that how can address the high dimensionality. So to understand this, it's good to go back and look at the directed information, how it's defined. So if you look at the definition, it's a summation of a set of mutual or conditional mutual informations that they have this whole network in the conditioning set. This is very important because we don't want to have any leakage of information when we want to measure the direct influence from time series I to time series J. Therefore, we have to condition on all the remaining time series. This will introduce a complexity to computing or estimating directed information. And as soon as the size of the network grows, then the size of the conditioning set also grows, and this is problematic. So we need to fix or limit the size of the conditioning set. And this we can use it using the Markovicity assumption that the time series, they don't have long memory and so on. And more importantly, using this conditioning on a fixed size set, namely the K, for example, most correlated assets. With doing this, we implicitly assume that the time series that are the direct cause, they are more correlated compared to the time series that they are not the direct cause. So with this, we can control the complexity a bit and then make the estimation easier. This is one approach, controlling the size of the conditioning set. Another approach would be, instead of learning the whole network, we approximate the network with a sparser network. For example, we approximate the network with the best directed tree. What does that mean? We approximate it. The approximation is in the KL divergence sense. That means we try to approximate the joint distribution of the dynamic with the distribution such that its directed graph is actually a tree. So this approximation problem is not very new, because we had similar type of approximation in Bayesian network, which lead to these Chow-Liu algorithms. So interestingly, we can show that this optimization also lead to some type of maximum spanning tree in directed networks. But instead of the mutual information as weights, now we have directed information as the weight. So the good thing here to notice is that for approximating a graph or a network with a tree, then we have a problem that we need to only estimate the directed information between pair of nodes, and therefore their size does not grow with the network or the size of the conditioning set. Okay. So after talking about directed information, how to modify it to capture influence between subset of time series, how to modify it to have it for time varying causal relationship, and addressing the high dimensionality, now it's good time to talk about how to actually estimate this object using samples. So to talk about that is just again a good time to go back again and look at the equation. The equation is a summation of conditional mutual information. Mutual information is a measure that is studied a lot in information theory, and there are many estimators actually for conditional mutual information. For example, all these kernel estimators, k-nearest estimator, which are all consistent estimators. So we actually used or combined the plug-in estimator and the k-nearest estimator in order to have a consistent estimator for our directed information, which you can see how it is formed. So this is one way to directly estimate the directed information quantities. But the next question is that often we really have some side information about the system. And if we have this side information, can we actually do something, use it to reduce the complexity? The short answer, yes. For instance, if we know the system is an autoregressive model, then we can learn the directed information graph only by learning the coefficient matrices. So we can show the directed information graph is actually positive if and only if the corresponding entries of the coefficient matrix are positive. Therefore, this side information that the model is linear can lead to a lower complex learning problem. Another example would be these Hawk processes. These are also a special point processes that are used in modeling earthquake, finance, and so on. And this is also possible to show that in order to learn the directed information graph, it's much easier to learn a set of parametric quantities, which is called kernel matrix, this omega. Okay, so the message here is that having side information can reduce the complexity of the learning the directed information graph. But again, we don't need to have the side information to learn the directed information. So in the paper, we also discuss other common famous econometric models like Gauss, moving average, and so on, and we show which parameter of the model actually encode the directed information graph. So the last part of our methodological contribution is that how to actually estimate these quantities if we don't have enough samples, which is often the case, where, especially in financial market, when we have a short time window of observational data. To handle this, we adopt the moving block bootstrapper method that can actually replicate IID type of samples, and we can have a better, more accurate estimate of the time-varying directed information quantity. So I will briefly explain how it works, and then we can go to the empirical study of this work. So the way it works, let's look at this picture. This picture actually, every column represents the time series of one asset. For instance, a special bank or the real estate. Each column is the time series of that. And the length of the column is basically the window of the observation. Then we have to adopt the rolling window approach for computing or estimating direct information. To do that, we fix a rolling window of size TRW, and then we move this window over time. But when we fix a rolling window, we have to compute or estimate the directed information within this rolling window. In order to compute or estimate the directed information in this rolling window, we construct a set of blocks, each block of length LB, and then we sample with replacement from these blocks and then replicate many IID blocks of the original one. So this is the idea of moving block bootstrapper, and then can replicate one block, and then we can create as many as we want number of blocks. So we use that to have to improve the accuracy of the directed information estimate. All right. So having said all this theoretical parts, definition stuff, it's good time to see actually how they work in practice. So we assess the performance of this measure first using the simulated data, which we know the ground truths, and then we also apply it to some empirical financial data and report the result. So first thing is that how effective is this measure to capture the nonlinear dynamic? So for doing that, we create actually a set of time series, 10 time series per se, as you can see the ground truth network from this ground truth network, using this data generating process that you can see on the left. It's something like a quadratic plus a cut function, which looks like a ReLU function. It ensures the stability of the time series, but it also adds a level of nonlinearity to the dynamic. So we generate the data using this data generating process, and then estimate the directed information using k-nearest and the moving block bootstrapper, compute the directed information graph, and decide whether there is an edge between two time series using some threshold tau. If the estimated DI is bigger than tau, we say there is a causal relationship. Less than tau, no causal relationship. So this definitely adds this hyperparameter, this threshold tau, that we can also study how it affects the precision recall of the learned network. So you see, we change the threshold from for an interval and computed the precision recall for the learned or estimated causal graphs. So it clearly can capture the nonlinearity in the dynamic very well. The next part is that how actually effective is that to capture the time-varying causal relationship. To assess this, we have another data generating process, both nonlinear and time-varying. As you can see, this AT, you can think of this AT as some time-dependent coefficient in the autoregressive model, yeah, that the entries are changing with time. And then we generate the data from this, compute the directed information, time-varying directed information that we propose, and we also compare it with the most recent measure on time-varying range of causality that is based on rolling window analysis of correlation, cross-correlation between the residual, which is this HT here you see in the bottom. So let me explain the figures here. What you see actually in figure A is the function in the is the function denoted by red in the matrix AT. So you see this function is positive for a certain amount of time and then suddenly jumps to 0. And then this means the influence disappears from time series 0 to time series 3. So this actually we can capture nicely with this time-varying directed information, which we estimated over time, and this is the second plot, the plot D. The last plot is what the measure in the literature can outputs. We also computed for different entries, actually for all the entries reported in the paper, but for the presentation I just brought some of them. So as you can see, directed information, which is the second row, can really nicely not only capture the causal relationship, but also the power of the relationship. For example, in the second column, you see as the influence power decreases, the time-varying directed information values also decreases. Okay, and also the some type of time-varying one, which is in the blue one. So, okay, with experimented with simulated data, which we know the ground truths. Now it was time to see on the empirical data set. For that, we start with the research question that whether crypto assets, they really are a threat to the financial stability. For that, we collected the data from January 2018 to 23 of 120 assets. 113 of them are stocks from different sectors like bank, diversified finance, and so on. And 11 major cryptocurrencies like Bitcoin, Ethereum, and so forth. And then we use our method to learn the causal graph between these financial sectors. We have 6 sectors. Now here each node represents a sector. For example, node 0 represents all the banks, which we had around 20 of them. Okay, so we learned this graph over time using our time-varying directed information. Here you just see 2 instances of these graphs. Edges and the weights on them represent actually the value of the estimated directed information. As the value is higher, the edge is more thicker and the influence is stronger. Okay, so this we could compute and calculate and plot, and also our influence measure, we could also understand the most influential asset in each of these financial sectors over time. So for instance, during the time period between 3rd of 2018 to 6th of 2018, the most 3 influential banks were JP Morgan, PNC, and so on. And the most influential one in diversified finance was Morgan Stanley, and so on and so forth. So we could have all these most influential or least influential over time of this observational data. So the message we got from this analysis is maybe better presented in these figures. So what we see here actually is the plots of the edges, for example, on the top left. If we focus on the top left figure, this is the influences that all other sectors have on cryptocurrencies. So as you see here, the influence that the sector 0 has on 5. 0 are the banks, 5 are the cryptocurrencies. Or the orange one is the influence from diversified finance on all the crypto currencies. So we could compute this over time from 2018 to 2022 using this rolling window and time varying approach. And on the right, you see the influences that has cryptocurrency on other financial sectors. So, for instance, if you look on the top right, one thing that you really see is that there is two peaks in the curve. The first one coincides with the COVID-19 crisis and consequently the Federal Reserve response to the crisis. So there was a jump on how much influence the other assets they have on cryptocurrencies. The other message we got from here is that, for example, there is a high influence from the cryptocurrencies on other financial sectors. Although their capital value is much smaller compared to the other sectors, such as bank and so on, but they have influences, and therefore the message would be the policymakers should consider the risk coming from the cryptocurrencies. So with the Learn network, we could do all other measures, for example, counting the number of edges between different financial sectors, within the financial sectors, and so on and so forth. And we could actually count and compute all these measures that are relevant for systemic risk analysis from the causal graph. So for example, in this plot, you also see, if you focus on the blue one, the blue curve shows the number of edges coming from other sectors into the cryptocurrency sector. So again, there are two types of peaks. One of them is during the COVID, and the second peak is actually around May 2022, and that was coincide with the collapse of Terra and the FTX crisis in November. Okay, so that was the empirical study. So it's a good time now to finish with the conclusions from future direction. So with this work, we used this non-parametric time-varying directed information measure for capturing the time-varying network of financial market. And also we define some measure for capturing influence between different sectors, and also quantify the most influential, least influential assets in each of these sectors. Empirically, we applied our method to analyze the systemic risk coming from crypto and to the financial networks. So the future direction would be most of this analysis are offline, meaning the data is collected and everything is computed. How we can actually improve the estimation as the new set of data is available to us. And then all of these analyses are based on when we have only observational data, but maybe there are some experimental data also available coming from different policymakers, how we can actually adopt interventional, observational, both together to learn the network. And also the next question would be, after we learn this network, how we can actually help the policymakers to do or design better or appropriate policy from the network. All right, so this was the talk. Thank you so much. I hope I was on time, and I'm happy to answer the questions.
Thank you.
Of course.
Thank you. I'm unmuted. Now I'm back on. Thank you, Jalal, for the presentation. Sure. And I'd like to ask anybody who wants to ask a question to raise their hand, and I will call on the questioners. And I think all of you have access and can speak up with your questions. Okay.
Professor Invens, maybe.
Yes, I saw. And I was going to say, I will ask the members of our review committee, give them priority in asking the questions, but I'll go with the ranking that Teams is giving me. So I'd like to ask Guido Imbens first to go ahead and ask the first question.
Okay. Can you hear me?
Yes.
Okay.
Yes.
Thanks. That was a very interesting talk. So one question was how sensitive are the results to the data in terms of the timing of the observations? Kind of if you use a longer window, or instead of using daily data, use weekly or monthly data, would things change a lot? And kind of slightly related to that, at the moment, and at least my impression was that you don't use the contemporaneous correlation in the changes. And again, that would presumably mean that things are a little sensitive to how often you measure the variables. So can you give some insights kind of into how sensitive things are, why you made the choices you did in that regard, and whether there was any contemporaneous correlation at the level of data you used?
All right. So thank you so much. Very good questions. I mean, so regarding the scaling of the time, yes. So we have the daily data. So the question was, if we go, for example, to different scale, like weekly, what would be the result? So, well, it definitely affects, and we did see the effect. But the main barrier here is that to have an accurate estimate of this directed information. In order to have an accurate estimate, we need samples. We need more samples, the better estimate. So it was going from daily, for example, to weekly. We saw much more, let's say we detect more noise than signal. So we didn't have a good estimate. So that was very sensitive to rescaling up, meaning that going from daily to weekly would mean that we will have less data and therefore less accurate estimate. So in that sense, it affects the learned causal graph. And the other one, as you mentioned, yes, we did not consider contemporaneous relationship because the directed information actually assumes that there is no such influences, because you always condition on the past. You don't assume there is a relationship at a certain time t. So this also affects on two sides. If we rescale the data, if instead of daily we go to weekly and so on, we actually add some contemporaneous, right, influences, and our measure is incapable of capturing this, right? Therefore, rescaling up, it affects both estimation power and also could lead to violating the assumption of the no contemporaneous relationship. Yeah.
May I also jump in, Jalal? Just in the original version of the paper, which predates you, Jalal, when we looked at directed information, we actually considered also allowing for having, simultaneous influences. So it doesn't break figuring out this notion of causality between pairs of time series. The problem arises in the network setting because it's basically, you can't have this analogy with the Bayesian network. So that's where it breaks. But if you just considering two time series, it's not a problem. If you're in your conditioning, you don't just go to like xi minus 1. You could also go to x current x xi. That doesn't bother the Granger part.
Yeah, that's a good point. Yes.
So did you see much of the contemporaneous correlation if you actually look at the data at the residuals kind of after you estimate these models? Do you see much presence of that?
Yes. So after if we scale it up, we will see, so meaning that if you go from daily to weekly, we will see more contemporaneous simultaneous influences.
Can I also add something here? We also see more nonlinearities when we have high frequency data. So when we have like low frequencies, such as weekly or monthly data, we are somehow killing, nonlinear relationship between assets. So we wanted to also show that, having high frequency data, assuming that we have more, tail dependencies, nonlinearities, and non-Gaussianities, the model is still able to capture those behaviors.
Okay, let's move on to the next question, and I'd like to ask Ricardo Rebonato to pose his question.
Thank you very much for your talk, really interesting. Could I go back? In your paper is figure 10, and I don't know if you can go back in your presentation. It is, I think, one or two before. Yeah, that's the one. Now, I'm looking at the left one, and if I am understanding this correctly, it is influence from 0, 1, 2, 3, and 4 onto 5, 5 being crypto. Is that correct?
Correct.
Now, I was very excited when I saw this peak. And then you told me the peak is COVID, which was not what I would have a priori expected. So what is the story? So you find, to me, alarm bell rings that there might be missing variables, and there are, what is the causal explanation of what is happening here? Why during COVID, all of a sudden, banks, diversified financial insurance, real estate, and financial technology begin to influence crypto so much, if I understand the graph correctly?
Yes, that's really the graph is conveying. Yeah, correct. So from the financial side, maybe Ali, do you have any comments?
Sure.
Yep.
Sure. Yeah, we can actually have two explanations for this behavior. So the first one is based on the Federal Reserve, quick response to COVID by having interest rate cuts. So it encourage investors to have more like riskier investments. And we also see like during the time that we have more institutional investors in cryptocurrency, which can be like even banks or other institutional investors. So the way that we are explaining this behavior is based on having a sharp interest rate cut by Federal Reserve, which basically motivates investors to go for like riskier investments.
Okay.
And
do you find therefore a decrease during the raised rate in the inflationary period? Because if your theory is correct, then you should see the inverse effect when rates have been raised during the inflationary period.
Yeah, and then there are not only one factor, to be honest. So it's not easy to like, show those kind of partial effects of different factors. But it seems that, even based on the market capitalization of assets during that period, and then the type of investors that we have over the time, we see like more institutional investors, and they do have like a portfolio both with cryptocurrencies and other type of asset classes. So having like more portfolios with diversified assets, including cryptocurrency, can also be some factor that we cannot ignore here. And that like interest rate cut also change the kind of like investment opportunities that we may have in the market.
Okay, so what I would like to do and give our advisory board members some priority and ask Alex Lifton next to pose his question.
Thank you very much. I didn't really, I was doubtful whether or not my raised hand were actually seen. Anyway, thank you very much for this very interesting presentation. So in a few words, to summarize from a practical perspective, so does the cryptocurrency pose a danger to the existing financial system or not, in your opinion, and after all your estimations? How would you characterize it in simple words?
We can say there are some dynamics. So the influences from cryptocurrency to other sectors, is not like consistent over time. So we see some periods that we have more influences from cryptocurrency to other assets. We have been like seeing 7 winters in crypto markets. As Jalal mentioned, we do have like FTX crisis, Tron and Luna crisis. But it seems that even before 2020, we still see some significant influences from cryptocurrency into other financial sectors. So, in some other works, people were saying that we don't see any significant, dependencies or correlations between cryptocurrency and financial markets. And in some cases, they only consider Bitcoin from cryptocurrency and then market indices as representative for stock market, and then they just run a rolling window correlation to analyze this kind of relationships. But here it seems that considering more information to appropriate models, we can capture some significant influences or spillover risk from crypto to other sectors, even like in 2019 or 2020 before pandemic.
All right. And what is, in your opinion, the kind of reason for that? Do you think that banks really lend money to people to buy cryptocurrencies, or because I personally don't know a single bank which would actually do this, right? So from that perspective, typically the danger for the banking system stems from the fact that they lend money and don't get it back, roughly speaking. So how do you explain it in the context of cryptocurrencies?
So what we're planning to do actually next is to probably have a multi-layer network by considering more information for each node. So in this, in the current work, we only consider, the asset prices and asset returns, but we're also considering having, some other layers with more information about each node to see if we can better explain this kind of dynamics and influences between sectors. But it seems that, and the reason that we also considered having fintech, which is not a kind of GICS, sector, but we could also try to, study other researchers to find some indices for fintech sector. And it seems that some, hedge funds or, banks, instead of investing in cryptocurrencies, they may invest in some companies who are highly correlated with cryptocurrency market. So we wanted to also see if we have this kind of influences in fintech industry or not as well. But maybe having more information for each nodes, having a multi-layer setting, multiplex network, can better help us to understand and explain this kind of behaviors and dynamics.
Thank you. I appreciate this.
Okay, so I wanted to ask Miguel Hernan, who is also one of our scientific advisory board members, to pose his question, but he seems to have signed off already. Miguel, are you still online? No, he's not, because I realized that we've reached already the hour. So I have 2 more questions on, 2 more hands raised on the board. So I'll put a last call out for questions, and then we'll cut off the questions. And the current 2 questioners, there's Pankaj, who has his hand up already for a while. Please go ahead and ask your question.
Thank you, sir. Thank you for the wonderful presentation. I have some basic questions. First is that it assumes no hidden variable and also a specific rolling window of data frame. But we know in finance and investment, there would always likely be such hidden unknown variables that could lead to black swan things, and also Simpson's paradox, which Professor Parado very much talks about. And also there exists some error random terms in your causal approach, and it can happen in any causal approach. That could be the cause for black swan things. So how robust your model is to means your approach is to that kind of black swan risk. And also the testing that you have shown on historical and simulated data, that could be highly biased, that Professor Prado very much talks about. So how do you how is your approach performing on the real live data? That is also quite important to avoid biasness. Thank you. Thank you.
Thank you. Very good question. So yes, as I mentioned, if and you also hidden variable, they are very tricky. Having them unobserved time series that there are influences like this, hidden confounders and so on, they can really mess many causal inference methods or causal discovery methods. So here we assume that what we observe is actually contain all the relevant information for causal discovery. So of course, if there are some hidden variable, they could sometimes be the indirect cause. Think about an example like time series X is causing time series Y, and time series Y is causing time series Z. So not observing time series Y in the middle does not really cause any or give damages to the inference problem, because you will pick an indirect causal relationship. The problem comes when there is a hidden common confounder, for example, a Y causing X and Z. So in this case, yes, it could lead to some misleading result. So here, for the experiment, because for the simulated experiment, we design it, we know the ground truths, everything is worked and satisfy all the assumptions, and therefore the results are satisfying. But for real world, like many other simulators, I mean, many studies in causal discovery, we cannot ensure 100% that, all the data contains all the available information. So this is an assumption, like many others. So I hope I could answer your question on this.
I can also add something about the simulation study. We could actually have an extra simulation study with the synthetic data generated based on real financial data. We were thinking of having like time varying factor models to generate multivariate, time varying series. But in that case, we still need to impose some kind of nonlinearities or some shocks to the data generating process if we really want to, evaluate our methods for all the aspects that we have added. But maybe we could also have that kind of simulation studies with probably a time varying factor model based on real financial data. It's easy to add that kind of simulation studies, and it may also reveal more information about the capability of the method. But please, if you have any suggestions how we can also consider like the hidden confounders or simulation studies, we would love to hear your suggestions as well.
Okay, I'd like to move on, thank you, and give Farshid Sogalchi the last question.
Thank you very much. Thanks to the presenters for the excellent topic. So my name is Farshid Sogalchi, as you said. I'm from the research department at Canada Pension Plan Investment Board. My question is about the charts that you're actually flashing. You alluded to, and on just building up on the previous questions, you alluded to possible dynamics that might be going on, and I was just wondering if you added some sort of a central bank policies or interest rates or cost of capital, an economic variable like that, amongst the other variables that you have in there, other than the financial sectors and etc. whether would you expect the charts would change or the story would change? Is there like that confounder variable? Could it be something like that? You know, the availability of capital in the financial markets or the liquidity?
Well, yeah, as you know, Jalal suggested we could also do some kind of like policy analysis, some kind of like considering like you know kind of intervention by policymakers, and then see how it will affect on the systemic risks in the financial sectors. But as we are also considering, you know, time series for cryptocurrency markets, we have some limitations to consider all the you know, rules or policies that have been already proposed by central banks. Some of them are like much before the 2018, and even like the updates that they have, the most recent one is also before 2018.
Thank you.
Okay, so at this point, since we're already over time, I would like to thank our speakers for their stimulating presentation, and also our reviewers for participating in this award competition. And also want to thank them for all the stimulating questions. So I wish you a good evening or a great day. And I hope this was an exciting opportunity, and so that all of you will sign up again next Wednesday.
Thank you.
Thank you.
Thank you so much. Thank you.
Thank you. Goodbye.
Goodbye.
Thank you.
Thanks.